Some say that it's going to be a lot of rate cutting this year. Some say none. What say you?
I say that really it will depend on the path of the economy. Our focus is on maximum employment and price stability.
Skyrocketed.
Will you work with the CFTC to address this problem?
Boom, a boom.
It makes me nervous because this has echoes of 2008, 2009.
And I can tell you China is watching this like a hawk.
The immigration surge has added to our strong labor force, which is necessary.
They actually blame you guys.
We took our medicine. What I would like to do is
So you don't want to do it this year? I mean, I'm being serious. You're saying no?
Well, if we'll pause the clock, we can have staff take a look at the microphone. The awkward photos for Trish will be less awkward.
That's it.
Today we welcome the testimony of Jerome Powell, Chair of the Federal Reserve's Board of Governors. And there's been a great deal of speculation about when the Fed would cut rates. Some say that it's going to be a lot of rate cutting this year. Some say none. What say you?
I say that really it will depend on the path of the economy. Our focus is on maximum employment and price stability, and the incoming data as they affect the outlook, and those are the things we'll be looking at. I can go further if you'd like.
So at what point will the Fed be forced to cut rates? What does the data, what kind of data would you point to, and do you have any updates there?
What we've said is that the committee would like to see more data that confirm and make us more confident that inflation is moving sustainably down to 2%. We have some confidence of that. Inflation, headline inflation has moved down more than 3 full percentage points now to 2.4%, as I mentioned in my remarks. We want to see a little bit more data so that we can become confident and so that we can take that step of beginning to reduce policy rates. It's a very important step. We think because of the strength in the economy and the strength in the labor market and the progress we've made, we can approach that step carefully and thoughtfully and with greater confidence. And when we reach that confidence, the expectation is we will do so sometime this year. We can then begin dialing back the restriction on our policy.
So to address these imperfections in the housing cost indicators, the Bureau of Labor Statistics and Cleveland Fed created an improved methodology based solely on new lease rents, which is referred to as new tenant repeat rent index. Has the Fed incorporated this new indicator into its economic assessments? If not, why not? And so, what changes has it had on the level of housing inflation observed by the Fed?
So we're well aware of that, and we do incorporate it into our thinking. As I was starting to mention, that is the reason, the fact that market rents are moving up at a much slower pace is the reason why forecasts are for housing services inflation to come down, and that absolutely plays a role in our thinking.
There's no doubt that inflation is the biggest issue facing American households, and in my view, there's three principal causes. Certainly we had supply disruptions, but we've had unprecedented fiscal policy laxity. You described it in a recent interview as unsustainable. But we also think that the Federal Reserve, in my view, and many people on this committee commented, should have reduced accommodation after the pandemic sooner. One of the things coincident with that, which is what I want to talk to you about, is that the FOMC announced in August of 2020 this flexible average inflation targeting framework right in the middle of the pandemic, which many of us didn't understand why the Fed would take that decision then. But it would give you flexibility on the 2%, saying the Fed could allow inflation to rise above 2% and stay there above that level for some time because the Fed had such challenges in getting the price level to 2%. That was a major shift in the Fed's approach. Do you think, in retrospect of now what we've witnessed over the past 4 years, that that was a mistake in hindsight to change that framework, and is it under review?
So we said we would do a review on a 5-year basis, and that means we'll be starting that review toward the end of this year. So we really haven't started. I do think that the question you raised will be one of the questions we look at, but the bigger question really is that change in the approach was really based on the fact that we'd had very low interest rates and very low inflation for a long period of time, and policy was always very close to the effective lower bound, so there wasn't any firepower for central banks, and so it was a way to keep inflation expectations anchored at 2% and not have them slide down. Now we have entered a different period. The pandemic really may have changed that in a sustained way. We don't know that yet, but that's the big question we'll be asking ourselves is the effective lower bound to be thought of in a different way now? And if it were, that would have ramifications for our framework. But we haven't begun the review yet. It'll begin at the end of this year and probably end late the next year.
Thank you. Yield back, Mr. Chairman.
Gentleman yields back. We'll now go to the gentleman from New York, Mr. Meeks, for 5 minutes.
Thank you, Mr. Chairman. Thank you, Chairman Powell, for being here. And I think I want to pick up a little bit right where we are. 2019, 2020, the entire world was under the unprecedented pandemic with COVID rate. Is that correct?
Yes.
At the time. And that changed a lot of things with reference because not just for the United States, but for the entire world. And it affected the economies of countries just about on the planet. That's not also correct?
Yes.
And supply chains was disrupted. In fact, I can remember many Americans and people around the world could not get toilet paper or paper towels and some of the basics. And so the prices, because of the of supply and demand, skyrocketed, causing the inflation, not only in the United States, but basically all over the world. Is that correct?
Yes.
And so therefore, the Fed had to do certain things because of what we were in at that particular time. We couldn't just go back and act like the pandemic wasn't there. We had to do something to try to make sure that we were able to get through the pandemic. Is that not correct?
Yes.
And now we're at that point where we're about to get through this pandemic. And we can look at the rest of the world, what they did or didn't do at that time, but what we did at that time. And as a result of that, 3 years post the pandemic, when you look around the world, I think that you were correct with what you stated, that by most accounts, our economy is doing well. In fact, I would say our economy is doing better than most of the other countries in the world. Would you say that's correct?
I would.
I'd now like to focus on how the proposal is set to significantly disincentivize banks from offering clearing services. In Dodd-Frank, Congress mandated central clearing as a way to reduce risk in the system. The number of banks that can clear derivatives for end users has reduced over time, making it harder for end users to find a bank to offer this service. There are some estimates that the Fed's proposal will increase capital for this activity by 80%. I'm worried that this will make it even harder for end users to find a bank to clear their hedges. This also comes at a time when the SEC, our friends at the Securities and Exchange Commission, has just finalized a rule in December that will increase clearing in cost in Treasury markets. This will have a real impact on market access and liquidity, not just in commodities, but the $26 trillion Treasury market that plays a critical role in the world economy. Will you work with the CFTC to address this problem?
Again, I'll say that we're aware of those concerns and we're prepared to work with other agencies and also to make sure that our capital proposal appropriately addresses them.
Are you now at a point where you believe that there will not be a recession? There was much talk about recession, and many people worried that we would find ourselves having to negotiate our way out of a recession. What is your position currently on a recession?
So U.S. growth last year was in excess of 3%. What we're seeing so far this year is continued solid growth. My expectation and that of other forecasters and of my colleagues is that we'll see continued growth at a solid pace. I will say so there's no evidence or no reason to think that the U.S. economy is in or in some kind of short-term risk of falling into recession. Having said that, though, there's always a possibility, a meaningful possibility that an economy will fall into recession. I don't think that possibility, though, is elevated at the current time.
You talked about policy. So what's your advice to policy about energy and what this administration is doing on a policy perspective?
We have, broad, significant, important responsibilities, but we're really not responsible for energy policy, and we try to avoid commenting on.
But it
things that
has
we're
a
not
huge
responsible for.
impact on this report. It arbitrarily keeps prices high. It arbitrarily means that business is not, while they're making money, and while households, people do buy that, it's diminishing their long-term advantages to make progress. So you're just going to leave that alone?
Really not appropriate for us to comment. On if I'm commenting on energy policy, I should comment on everything. We have a mandate which is maximum employment and price stability. We take decisions by the legislature and by the administration as a given. We're not in charge of second guessing them. It's just not our job.
Okay, well, all right, let's say we're not going to second guess them. I will. I believe that the energy policies that this president and the Democratic Party have supported are causing a huge boom in prices staying high. They will not come down. A boom in attacking the energy industry, jobs that are associated with it, our foreign policy as it relates to contracts that we have signed with foreign countries.
In a 60 Minutes interview a few weeks ago, you characterized distress in the commercial real estate market as sizable but manageable. Do you still feel like that risk is manageable? Do you feel like you've got the visibility and the transparency and the tools to address it? It makes me nervous because this has echoes of 2008, 2009, when vacancy rates were declined relatively rapidly. We're not seeing that right now. So how do you feel? Does that risk continue to be manageable, and do you have the tools to manage it?
Yeah, I would say yes to that. I think it is manageable, and we've been working hard to management for some time now, really. And what it really is it's a lot of downtown real estate where there's too much office supply because of work from home, and also the kind of downtown retail that is no longer as profitable, and things like that are really at the heart of it. So what we've done is we've looked at banks that have significant concentrations, and we've been in touch with them to make sure that they have a plan to deal with that. There will be losses by some banks. It isn't really the big banks, it's really medium and small-sized banks that have these higher concentrations. It's going to be with us as a problem we'll be working through, I think, for several years. And the idea is you've got to have enough capital, enough liquidity, and a plan to take the losses that you're probably going to take.
And I tell people, I said, think about this for a second. You find some individual who is a well-known individual, perhaps Larry Kudlow, Dave Ramsey, Bloomberg, somebody who has got credibility, and suddenly you see an artificially produced advertisement or Facebook post, and this person says, look here, we've got 100 banks that have got a problem today. Now, that individual didn't do this. It's artificially produced. I've seen a commercial already with individual. You couldn't tell the difference between that individual and the real thing. We have just come through the Silicon Valley situation. And if you have real-time payments, FedNow, where you can instantaneously transfer money, and you have people scared to death by some well-known individual through an artificial intelligence situation, and I can tell you that China is watching this like a hawk. They are ready to pounce on this situation. To me, I've got some bills that actually would solve the problem. Do you think there's some issues here we need to be taking a look at?
Yeah, I think we're very focused on AI, many government agencies and law enforcement agencies in particular. It's very challenging. You paint one picture, there are lots of pictures.
Gentleman's time has expired.
It's interesting because the foreign banks actually are watching this. Thank you.
I'm simply asking if you agree that the immigration surge has added to our strong labor force, which is necessary. I think you said that we expect a continued growth at a solid pace. So to be able to continue on a solid pace, then we need that labor force. Wouldn't you agree?
Well, so last year we got a big increase in workers, and it came from two sources. One was participation increased from people who were already here, and in addition, we got a significant increase in immigration, and many of those people take part in the working economy, and so there was a big increase in labor supply. That will have increased output it will have made more people, it will have all kinds of economic effects.
I do want to touch on the bank failures of last year very quickly. Do you think that the banks that ultimately needed the government bailout lacked sufficient capital, or was it more of a management problem?
So with Silicon Valley Bank, it wasn't really, could they have used more capital? I mean, they were actually raising capital. It was a capital raise that they announced that triggered the run and everything. So you can argue that it needed more capital, but I wouldn't say that that was the proximate cause, really. It was a funding structure that was all about too much concentration of
Well, many of us are, I'm asking the question because many of us are very concerned that those failures are being used as an excuse to raise capital standards across the board.
So the April Federal Reserve report, it said that compensation incentives contributed to the Silicon Valley Bank's failure. Do you agree with that?
I would say it's at best a tertiary factor, but it probably had something to do with it. For me, not a major.
So that's no?
That's very small.
Okay, so it did. Okay. So do you agree the appropriate rules on incentive compensation could have reduced the likelihood of Silicon Valley's failure? Maybe. You know, if they didn't take all that money.
No, I really don't think so. I mean,
So if they didn't take all that money?
I don't think it's a first-order question for Silicon Valley. A lot went wrong there.
Yeah.
Incentive comp would be
They actually blame
way
you
down the
guys.
list.
They
Sorry?
blame the oversight, even though they didn't respond to your
That's part of it.
correspondences.
We took our medicine.
Yeah. So do you believe in a robust
I
rulemaking
believe-
process for executive compensation?
I do, yeah.
Oh, great. Oh, that's awesome. Will you commit to helping finalize the Dodd-Frank section of 956 this year?
I wouldn't
It's been
say that.
12 years, Chairman.
Yeah, no, I want.
It played a role in the bank failure, Chairman.
If I can answer, what I would like to do is
So you don't want to do it this year? I mean, I'm being serious. You're saying no?
If the member will allow the witness to answer the question, we've had a good day today, and the gentleman's trying to answer the question.
I would like to understand the problem we're solving, and then I would like to see a proposal that addresses that problem.
Okay. Do you believe people should profit off of bank failure? The executives that made those decisions?
No, not the
They should not
executives.
profit.
Well, I would say executives who are responsible for a failed bank should not profit from the failure. Absolutely not.
So they get to walk away with compensation based on their failure?
Well, you're asking,
It's true,
you're asking
it
about a different rule that would have clawback and things like that?
Yeah.
Yeah, so that's something I know you've been looking at for a while.
Yeah.
That's certainly an appropriate thing to look at.
Yeah, because it's just going to continue to happen, is my opinion. It doesn't have to be yours.
According to your semi-annual report, the median of members on your Monetary Policy Committee estimate that your target overnight interest rate will average 4.1% in 2024. Does that mean that the median number of members anticipate that you will be cutting interest rates sometime this year by as much or more than a full percentage point?
No, it doesn't mean that. Actually, the Summary of Economic Projection showed a median of, this is in the December FOMC, so this is now 3 months old, showed 3 rate cuts this year. So that would be 75 basis points, 3/4 of 1 percentage point. You were quoting the next year's number, so you would add that on. That was through 2025, I believe.
Is the Fed monitoring the rising cost of insurance and its impact on macroeconomic?
Well, if we'll pause the clock, you can have staff take a look at the microphone.
We
The
need to
clock being frozen is out of respect for Ms. Velasquez, or out of good luck, I'm not sure.
the clock.
But we'll get staff to listen. We'll just suspend for a moment.
We need to invest in infrastructure for this committee.
Yes. Well, we're trying to do electronic voting, and
It's not voting.
no, it's hard enough to just get the microphones to work. Madam Clerk, thank you. Thanks. So all the photographers have left, so the awkward photos for Trish will be less awkward.
Why did the Federal Reserve choose to do a quantitative impact study during the comment period for the proposal, foreclosing any ability by the public to comment on the results of the study?
Well, I mean, the movie's not over. We are where we are, and Vice Chair Barr did commit to putting the QIS out for comment. We will receive those comments, and those comments will be taken into consideration as we think about the path ahead.
Well, speaking of process, you've got your excellent general counsel right behind you there. And I don't want to get into privilege here, but have the lawyers at the Fed raised any process concerns or Administrative Procedure Act issues with the board?
Let me just say that we're committed to doing transparent and reasonable and data-based rulemaking in compliance with the Administrative Procedure Act.
Well, of course, giving the public the ability to comment on the quantitative data that has been provided obviously is consistent with good process.
I am seeing in my own city of Boston, we've got 20% vacancy rates in office space. We rely on that for a lot of the tax revenues for the city. But I'm just wondering your thoughts on that issue. Is there a systemic concern here? Or is this isolated, and might lowering the interest rates help some of those banks? Because I hear from my developers in our area that no one's lending. So, you crack at it?
Sure. So I haven't seen that report, so I can't comment on it, but I can comment on commercial real estate. So we've had a secular change in the economy, which has left office rentals in many places, office buildings, the demand for them is significantly lower, at least temporarily and perhaps for a long time. And also the same is true for downtown, in some places, downtown retail that's associated with office workers. So it's a shock to the system, and we've known this for some time, and we've gone through the commercial banks in the United States, and so have the other regulators. We've done it jointly and identified the ones that have high concentration and are going to need to deal with that. And so we've been in contact with those banks and talking to them about how they're going to deal with this, how are they going to absorb these losses, do they have enough capital, do they have the liquidity, do they have a plan to do this, and is it consistent with their lending practices and that kind of thing. So it's going to be something we work through over a period of years.
Quickly, the ARPA injected nearly $2 trillion of deficit spending to our already struggling economy, and how does this type of inflated spending combined with economic headwinds like supply chain shortages impact the economy? And doesn't this kind of reckless spending actually fuel the pressures of inflation?
I think there are a lot of causes of the inflation we've seen. We saw this inflation everywhere in the world, so the reopening of the economy after with very strong demand and constrained supply. You saw inflation in all the advanced economies. It was a little sharper here at the beginning. I think there's a role for monetary policy in that. There's a role for fiscal policy. There's a role for the pandemic, a starring role for the pandemic. Our job is to deal with it, and that's what we've been doing.
Obviously, we would cut interest rates a little sooner and a little more if your target was something closer to 2.3%. So I'll ask you, is there substantial economic analysis that argues that your target rate and the economy would work better if we had a slightly higher target than 2%?
Not really, no. What's happened is, you pointed out New Zealand, but what's happened is that 2% has become the global standard, and it's a pretty durable standard. I don't have any reason to think that it's a problem for the United States to get to 2% inflation. We're at 2.4% right now on headline inflation.
I would ask leave to add to the transcript of this hearing numerous articles that argue for something between 2.3 and even 3%. I'm not arguing for as high as 3%.
What do you view as the driving force behind these record high levels of credit card debt?
Part of it would be growth in the economy, so that'll be part of it. Just that it's a bigger economy and a bigger number. I'm not sure what that is. As you know, people had lots of extra cash during the pandemic from forced savings. They've spent that down. Now they're borrowing. I'm not sure.
So If there was a rule to force banks to tighten lending, do you think the rule would drive businesses and consumers to alternative forms of credit?
I do. I think, if you raise lending costs for banks, then at the margin that will make non-bank lenders, they'll get some of that business.
And we've seen in the crisis of 15 years ago, we saw what many people thought was an inadequate fiscal response, that the fiscal response was less than half of the output gap. And we limited by political will to do things. And then, of course, you were limited by the zero bound in what you could do for most of a decade, and we had a long recovery. And the comparison, to the COVID recovery has been very sharp, and it's quite remarkably put us right back on that track. Are there any lessons that you've sort of drawn about the importance of the getting the right balance of fiscal and monetary response to these shocks?
So we think about that a lot, and I think I have to start by saying it's too soon to really tell, because the answers you would give today, the picture looks very different than what it looked like a year ago. And so, and a year from now, we'll be looking back going and saying, we've learned so much more. So I think the pandemic is still writing the story of our economy right now, and we should just be prepared to be surprised with the next chapter, as we were with 2023, the very strong growth, the sharp decline in inflation while the labor market remained very strong. Very few forecasters had that, but we can talk about it.
So right now, the interest you're paying banks and money market funds exceeds the income you're getting on the $7.6 trillion balance sheet assets that you have, to the tune of $133 billion asset. So, effectively, the Fed is operating at an operating loss. So what's the path back to cash flow positivity for the Fed?
As you know, for many years during the QE, large balance sheet period, we've contributed way over $1 trillion in net earnings to the bank, to the Treasury Department. So you can't look at the loss without mentioning that we've been giving effectively $100 billion a year in profits every year to the Treasury Department. So the other side of that is when we raise rates to do the job you've assigned us to get inflation under control, when we do that, we absorb paper losses. It has no effect on our operating, the way we operate the Fed. And if we retained all the earnings we have, then it wouldn't be a problem. But we don't do that. We give that money to Treasury.
Are you concerned about the effects that interest rate hikes are having on the cost of financing new construction? And the second part, how do you expect to control for long-term housing inflation that might have a potential rate cuts, how it might affect that?
So our policy to bring inflation down is to raise interest rates, and that works through several channels. One of them is probably the most important, is interest-sensitive spending, and within that you have housing and durable goods and things like that. So, during the early days of the pandemic, the housing industry was about to all go bankrupt, and all of the facilities that we did really supported that industry through their critical time. When we're going in the other direction, when we're raising rates, housing is definitely affected. We understand that. It's not something we want to have happen, just it is the reality that housing will slow a lot when you raise interest rates. We've done that, and we're doing it for the longer run benefit of the people we serve to restore price stability, which is beyond value for people to have price stability. We get it that in the near term, that's higher rates, that's fewer sales, people are locked into low rate mortgages, we get all that, but we got to do this because it'll benefit the country and people in the longer run.
It is concerning that the Federal Reserve is directed to is directing the risk transfer, yet also impeding it, in my view. Can you comment or can you commit to reviewing this approval process and taking steps to reduce the backlog of pending securitization applications?
So, as I understand it, these transactions are becoming popular right now. There's a lot of appetite to do them, and we're not stopping them. We're just being careful because there were similar things that happened about credit risk transfer during the global financial crisis that didn't actually work out. So we want to make sure that these structures really do actually durably transfer, and we think that they do, but we just need to be careful because the last experience with these was difficult back in the last crisis. So it's just something that we're not intending to slow these down, and I think we'll try to get through it.
I really appreciated your comments in the 60 Minutes interview last month when you mentioned that immigration is a big part of the story of the labor market coming back into balance. Now, generally, and correct me if I'm wrong, more immigration is generally going to ease inflationary pressure. Is that all else equal? Is that a safe characterization?
You know, it's probably closer to neutral, actually, because people come in, they also spend, so it's not clear that immigrants coming in, they add to GDP.
Okay, so either we're going to get economic growth and or downward pressure on wages.
More workers, that wages might go up a little bit less, but at the same time they're also spending. So we had this conversation. It depends on what you assume, but I think it's better to just assume it's sort of broadly neutral from an inflation standpoint.
If these proposed regulatory changes had been in effect prior to the fall of SVB and Signature, do you believe the outcome would have been different? Because honestly, I don't think anything would have changed.
It's a hypothetical. I'm tempted to say that if there had been more long-term debt there that was specifically there to absorb losses.
They were nowhere near being solvent. But I guess that's something I think y'all should take into account, whether if these proposed changes to our system that are designed to make it more resilient would have actually caused SVB and Signature to have a different outcome. Because again, it just seems that my colleagues across the aisle let no crisis go to waste, and these are changes that would not have, in fact, prevented the calamity that they are justifying the changes based on. Thank you for being here today, and with that, Mr. Chairman, I yield back.
It's clear that the current state of our housing market is impacting everyone and disproportionately hurting those who need stability the most. Does this concern you?
So our job is to do price stability and maximum employment. We don't target the housing market, and we're doing our jobs. That's what we're doing. It's not something we want to see, but
does this
is
impact
the
on the
path
housing
to restoring
market?
price stability.
But does it concern you, Chairman Powell?
Does it concern me?
Yes. Fewer homes are being built, so fewer people are being housed.
This is the job we've taken on.
All right. Well, it concerns me greatly.
The Fed now, where the Federal, I think, Reserve launched and is operating this now, how is the participation rate going with that?
Slow, real slow. It's early days. There are network effects. These things they go slow until they don't. And it was the same way with ACH. You may remember back in the day.
Right.
So we're at fewer than 500 banks are in there now. We're working away at it. We expect it'll take some time, but it's there, and we think it'll be beneficial. We had a lot of support from smaller banks to build it, as you know.
Is the pricing below cost?
I don't believe so. No, not longer run cost.
Okay.
At a time where it has become increasingly difficult for working people and people of color in particular to purchase a home, I worry that rising mortgage rates will put working families even further behind on accessing the wealth and equity that a home provides. So what actions, if any, is the Federal Reserve considering to better understand and to mitigate the impacts that your Basel III proposal may have on minority borrowers who disproportionately rely on high LTV mortgages due to the generational wealth gap that persists?
We've received comments, including many, on the mortgage changes, and we understand the concerns, and we're looking very carefully at that. Haven't made any decisions, but we will announce them when we have.
The Securities and Exchange Commission held an open meeting today to approve the final climate change rule. It's a significant regulation that I think would have a significant impact on the economy. Can you comment how the Fed thinks about the economic impact of this new regulation or regulations more broadly, and in particular their impact on both inflation and on employment?
We don't comment on regulations of other agencies, sorry.
And you'll review that if it's put in place, or you'll review the economic impact as the empirical data comes forward?
We're not in the business of scoring, CBO does that. They'll look at this and make a careful assessment of the economic impacts and budgetary impacts and that kind of thing.
Thank you.
If the purpose of Basel III is to align U.S. banks with their banking peers elsewhere in the world,
why is the Fed imposing requirements that are more stringent than those prescribed by Basel III? In other words, why is the Fed, quote unquote, gold plating? The third question is, how do you reconcile Basel III's recommendation for standardization with Congress's statutory requirement for tailoring? Standardization would seem to be in conflict or in tension with regulatory tailoring. And the fourth and final question, do you think that Basel III could have the unintended consequence of reinforcing the trend toward shadow banking, which would mean less regulation, not more? Is there a sense in which we are transferring risk from the regulated sector of the financial system to the deregulated sector? So I bombarded you with 4 questions, and I'll give you the time you need to answer them.
I'm going to have a hard time reading my handwriting here, but I'll start with yes to the fourth one. I'll give you that one because that is clearly a risk. We've seen intermediation activity moving out of the regulated system, and this has the risk of doing more of that. So what was, in a word or two, what was the one again?
Just you said, and you testified,
capital, yeah.
repeat reassurances about the capitalization of the banking
So
system.
I addressed this in my remarks in the open board meeting. You know, higher capital is always going to add to safety and soundness, but there's a cost.
Right.
And so identifying the precise right level is very, very difficult. It's hard to do it objectively. I've said for years in these rooms that I thought that the level of capital in the U.S. banking system was about right. So I posed, and I voted for all these increases during Dodd-Frank. So I think it's a very fair question. We'll be looking at that. The second one was
the concern about gold plating.
About
gold plating?
Oh, gold plating. Yeah, no, it is, and I said this in my public remarks that we're exceeding the minimums with this proposal, and we also exceeded what the other big jurisdictions are doing. And so that's a question. That's a good question. I'll agree.
Okay, great.
And the third?
And the third is, I think you more or less, and standardization versus tailoring.
Standardization of, it was something
Yeah, so Congress passed a statute requiring regulatory tailoring.
No, that's
and do you think Basel III is in compliance with that
I addressed
statute?
in my comments too. I think you're right. We do need to take on board the lessons of Silicon Valley Bank as it relates to the smaller, large banks, but we don't need to throw away the tailoring that's required by the law, but also that is appropriate if we're going to have a diverse banking system.
And with that, this hearing is adjourned.